When you glance at a crypto and stock chart, you'll see candles forming with every tick and every minute. It's tempting to imagine that price movement is an inevitable process, happening simply because the market is open and time is marching forward. But this is a misconception. Price doesn't move because the clock is ticking. It moves because liquidity is found, sought, or exhausted. Let's shift your perspective and reveal why liquidity is the engine behind every price swing, spike, or drift. Recognizing this foundational concept is crucial for anyone who wants to interpret charts with genuine insight and confidence. In our previous video, we outlined how market structure lays the groundwork for understanding price action, mapping out session overlaps, volatility cycles, and the distinctive rhythm of opening and closing bells around the world. Today, we build directly on that base by exploring liquidity, the dynamic force that determines when price will respond. Structure establishes the parameters and timing of the market, whereas liquidity determines when and how transactions occur within those boundaries. If you want to predict price movement, you must look beyond mere timing and ask why participants are motivated to transact at a specific moment. In every session, the question is not just when, but why. The answer, time and again, is liquidity. Liquidity in the realm of trading and investing refers to the ease and efficiency with which assets can be bought or sold without causing significant price changes. It's not a vague buzzword or a mythical market aura. It's the practical reality of available counterparties ready to transact at or near the current price level. If you want to buy, liquidity is the pool of sellers who can fill your orders without sending prices soaring. If you want to sell, liquidity is the crowd of buyers who can absorb your inventory without forcing you to accept lower prices. Imagine two columns, one representing buy liquidity, the other sell liquidity. The broader and deeper these columns, the less impact your trade will have. But when liquidity is thin, even modest orders can move markets dramatically. Always remember, price doesn't wander randomly. It actively searches for pockets where enough counterparties exist to absorb the flow, making the transaction possible and fair. This search for liquidity is the secret language of the chart. Numerous market analysts tend to equate trading volume, the aggregate quantity of shares, contracts, or lots exchanged, with liquidity, assuming that one necessarily indicates the presence of the other. This is a critical error. Volume catalogs what has already happened, the historical record of transactions completed. Liquidity, on the other hand, is about what could happen next, the pool of pending orders waiting to be matched. High volume can exist alongside poor liquidity, often evidenced by sudden gaps where price leaps due to insufficient counterparties. Conversely, steady liquidity can facilitate smooth price action even with moderate volume, keeping spreads tight and slippage minimal. Think of volume as footprints in the snow, evidence of movements that have already occurred. Liquidity is the landscape itself, the terrain those footprints traverse. If you rely solely on volume metrics, you're driving with your eyes glued to the rearview mirror, missing critical cues about the road ahead. Understanding this distinction is vital for effective market analysis and trade execution. Liquidity isn't randomly scattered across the chart. It clusters around specific predictable price zones due to the behavioral patterns of market participants. These clusters act like magnets, drawing price toward them because that's where the greatest concentration of pending orders and stop losses reside. The key zones include 1. Obvious stop areas, just above recent highs and just below recent lows, where traders place protective stops, creating pools of buy or sell liquidity. 2. Round numbers and clean levels, favored for their psychological significance and ease of reference. 3. Regions where price previously moved rapidly, which are often revisited as the market completes unfinished business and fills skipped orders. Visualize a diagram, a central price line surrounded by bands labeled buy stops, sell stops, and limit order. When you grasp these liquidity concentrations, you stop seeing charts as random squigglies and start reading them as maps of collective intent, anticipation, and behavioral bias. Imagine price as an algorithm, a search engine programmed to seek, test, and consume liquidity. Its motion isn't arbitrary. It follows a repeating cycle. 1. Scan. Price trades quietly within a range as liquidity remains balanced. 2. Approach. Price drifts toward the nearest pool where liquidity is expected to reside. 3. Trigger. Once at the threshold, stops are fired, breakouts occur, and momentum traders jump in, releasing a wave of transactions. 4. Absorb. Large players step in, filling orders into the surge as the liquidity pool is tapped. 5. Reprice. When the pool is drained, price must adjust to find the next available liquidity. This is why you'll see explosive moves into levels, sharp spikes, and swift reversals that often seem senseless to the untrained eye. In truth, these actions are the logical outcome of liquidity events, far more substantive than simple support or resistance. Understanding this model will fundamentally change how you interpret every price move, every wick, and every volume spike. The term stop hunt often evokes suspicion in tales of market manipulation, but such events are primarily mechanical, driven by the structure and distribution of liquidity. When a dense pocket of stop orders accumulates just above a local high or below a local low, price will gravitate toward it, not because of a grand conspiracy, but because it's the path of least resistance. If a large participant needs to trade substantial size, targeting these zones unlocks instant counterparties, enabling efficient execution. Picture a game of chess or the subtle dance of a predator and prey. The market systematically seeks out areas where it can conduct the most business within the least effort. When price surges into a stop cluster and liquidity floods in, that's not magic, it's market mechanics at work. Most stop hunts are simply the inevitable result of how orders are structured and how liquidity is accessed, not evidence of manipulation. Technical indicators, RSI, MACD, moving averages, and more feature prominently in most traders' toolkits. However, it's crucial to understand their real function, which is measurement, not causation. Indicators reflect the underlying condition created by liquidity and order flow, not the other way around. For instance, RSI flags momentum exhaustion after liquidity has been consumed. MACD highlights acceleration once liquidity imbalance has developed. These tools are like dashboard gauges, giving you feedback on market conditions. But if you mistake them for steering wheels, attempting to drive the market based on indicator signals alone, you're heading for trouble. Always remember, the true driver, the hand on the wheel, is liquidity. Use indicators as confirmation, not as your sole compass. To transform your market analysis, adopt an observer's framework focused on liquidity flows rather than static price levels. Here's a practical checklist to apply. 1. Locate the nearest obvious liquidity. Recent highs, lows, and round numbers are prime candidates. 2. Assess the speed of price travel. Rapid moves often signal a hunt for untapped liquidity, while slower moves suggest balancing and less urgency. 3. Observe reactions at liquidity pools. Does price spike, trigger orders, and then hesitate, absorption, or does it break, retest, and smoothly progress, sustained participation? 4. Monitor liquidity expansion or contraction. Watch spread behavior, overlap of candles, and how easily price pushes through small resistance zones. This isn't a trading system, it's a lens for seeing market intent. helping you distinguish genuine moves from shallow liquidity sweeps. Applying these questions will reduce surprises and enhance your ability to anticipate market behavior. As we wrap up, the central lesson is clear. Liquidity is the catalyst for price movement, the hidden force that animates every chart. Price doesn't surge at random hours or because an indicator flashes. It moves when there is real reason to transact, when orders are concentrated, and when size can be filled at any given level. In the next video, we'll peel back another layer, examining how liquidity dynamics create the moves that confound retail traders, failed breakouts, sudden reversals, and those relentless price runs that look designed to trap the unwary. When you internalize the logic of liquidity, you stop personalizing market action and gain clarity to read the market as it truly is. Be sure to subscribe and watch for part 3, where we'll translate these insights into actionable tactics for navigating even the trickiest liquidity traps.